Most people think crypto's just about trading coins, staring at red and green candles, praying the price goes up for a quick profit. They see headlines about meme coins and write the entire industry off as a giant online casino. But while everyone is distracted by the daily price swings of Bitcoin and Ethereum, something much more profound and disruptive is happening quietly in the background. For the first time in history, everyday individuals can directly participate in the financial infrastructure once exclusively controlled by massive banks, Wall Street hedge funds, and multi-billion-dollar institutions. It's a movement called Decentralized Finance, or DeFi for short, and it is changing the way money moves around the globe. Today, I'm going to explain exactly how it works, the technology behind it, and most importantly, how everyday people are earning predictable passive cash flow from it. To understand why DeFi is such a revolutionary leap forward, we first have to look at the problem with the system we currently use. In traditional finance, what we call TradFi, centralized banks have total unquestioned control. Think about what happens when you swipe your debit card for a coffee. It feels instant to you, but behind the scenes, that transaction is routed through a complex web of middlemen, payment gateways, clearinghouses, card networks like Visa, and your issuing bank. Every single one of these middlemen sits along the toll road of your transaction, taking a tiny slice of the pie in fees. When money moves, banks collect fees. When a business gets a loan, banks collect interest. When you overdraft, banks collect massive penalties. But where do banks get the money to facilitate all this in the first place? They get it from you. You deposit your hard-earned capital into a savings account, providing the bank with liquidity. The bank then turns around and lends your money out for a 10 to 20% return, while paying you a fraction of a single percent in annual interest. In the traditional system, the infrastructure is walled off. You provide the fuel for the engine, but the institutions take all the profit. That was the only way the world could work, until blockchain technology matured. Blockchain introduced a radically new idea. Financial systems can run on pure, open-source code. Instead of a bank verifying a transaction, approving it, and taking a fee, we use a smart contract. A smart contract is self-executing code living on a blockchain like Ethereum. Think of it exactly like a digital vending machine. You don't need a cashier standing there to facilitate buying a soda. You put your money in, press a button, and the machine's mechanics automatically dispense your drink. Smart contracts do the exact same thing, but for complex financial transactions like lending, borrowing, and trading. Instead of banks controlling the infrastructure, smart contracts manage transactions automatically, 24/7, 365. They don't take holidays, they don't have human biases, and they certainly don't have massive overhead costs like Manhattan skyscrapers or thousands of employees demanding bonuses. By removing the middlemen, the exorbitant fees that used to go straight to banks are now up for grabs. And this brings us to how regular people are actually making money in DeFi. Without banks, smart contracts need regular people to provide the capital. The code is just the engine. The engine still needs fuel. Let's walk through a real-world example, the foundation of DeFi cash flow. In the traditional stock market, order books match buyers and sellers. But in DeFi, we use an automated market maker, or liquidity pools. Think of a liquidity pool as a giant digital vault with two compartments. Let's say a liquidity provider deposits $10,000 into this pool. $5,000 worth of USDC, a stablecoin tied to the US dollar, and $5,000 worth of Ethereum. Now, a trader comes along with USDC, wanting to buy some Ethereum. They don't need to search for a seller. They interact directly with the smart contract vault. They put their USDC into the pool, and the contract automatically gives them the equivalent Ethereum based on a mathematical pricing formula built into the code. Here is the magic part, where the cash flow is generated. Every single time a trader swaps tokens, the smart contract charges a small fee, usually around 0.3%. In the traditional banking world, Visa or JP Morgan Chase would sweep up that fee for their shareholders. But in decentralized finance, that fee goes directly to the liquidity providers. If your $10,000 makes up 10% of that pool's total volume, you are entitled to 10% of all trading fees generated by that pool, forever for as long as your money remains deposited. This happens thousands of times a day. Traders, arbitrage bots, and institutions constantly swap tokens. Every transaction generates a micro fee. Those fees compound minute after minute, distributed to you automatically. Instead of banks earning transaction fees, you earn them. You are providing the financial infrastructure, stepping into the shoes of the bank, tying your cash flow directly to real economic activity. Now, you might be thinking, this sounds incredible. Why isn't everyone doing this? Here's a harsh reality check. DeFi is not risk-free. With high reward always comes significant risk. First, you're relying entirely on code. If developers leave a mathematical loophole in the architecture, malicious hackers will exploit it to drain the pool. If that happens, your money is gone. There's no FDIC insurance or a 1-800 customer service number to bail you out. Furthermore, some protocols are poorly designed economically. During the last bull market, platforms offered 10,000% annual yields. Let me be clear, if a yield seems impossible, it's usually because they're printing their own useless reward tokens out of thin air to pay you. That is a digital house of cards. True DeFi cash flow comes from real yield. Real people paying real fees for a real service, just like our liquidity pool example. That's why reading smart contract audits, assessing platform security, and understanding concepts like impermanent loss are absolutely critical. Treat this like a business. You wouldn't buy a brick-and-mortar store without checking its balance sheet and revenue streams. You must apply that exact same rigor to DeFi. But if you're willing to learn, the historical significance of what's happening right now cannot be overstated. Blockchain introduced digital sovereignty, the right to hold money outside the traditional system. DeFi operationalizes that foundation. It gives your money a job in an open, borderless global economy. We're watching a massive, once-in-a-century financial infrastructure shift. Just as the internet decentralized information in the 1990s, DeFi is decentralizing value today. The rails for the future of global finance are being built right now, block by block, and for the first time ever, regular people have a front row seat to own a piece of it. Navigating this space can definitely feel overwhelming. Figuring out how to safely generate passive income without falling for scams requires a solid foundation of knowledge. If you want a comprehensive explanation of how DeFi works, how to construct your portfolio, and how to evaluate protocols safely, I wrote a book on this topic called DeFi Cashflow. It cuts through the complex jargon to explain these systems simply and practically, so you can confidently start building your own digital wealth. It's available right now on Amazon, and I'll leave a link down in the description below. As always, let me know in the comments what part of DeFi you find the most confusing, and I might make a dedicated video breaking it down. If you got value out of this video, hit the like button, subscribe to the channel, and turn on the notification bell so you don't miss the next deep dive into the future of finance. Thanks for watching, and I'll see you in the next one.